Everyone, welcome back. We've got a great presentation lined up with Oliver talking through how he views the market, and then we're going to go through a ton of charts. If you have any questions along the way, please feel free to leave them down below in the chat. We'll have a dedicated Q&A session at the end. But yeah, first of all, Oliver, thanks so much for joining us today and kicking things off. Day two should be a great time, and really looking forward to your presentation.
Thanks, Richard. Can you guys hear me okay?
We'll see in the chat, but I think you should be going through perfectly fine.
Okay. All right, cool. Well, first off, thanks for putting this together. I mean, this is an amazing resource for people. I'm going to go back through and read through and watch all the different presenters. So this is awesome. Great way for people to learn. But it's what I'm going to be presenting on today. I mean, there's tons of different things that I could talk about. But sort of the root of what I do is based in something I call the cycle of price action, or the price cycle. I call it a couple different things, but I'm going to talk through that and kind of the advantages, disadvantages of it, and how it can help you stay on the right side of the market. And then from there, we'll run through some charts, some examples as to how I use it, maybe touch on a couple other concepts, and then we can open it up to Q&A. So you can see at the top here, I've just got cycle of price action, kind of is how I view this. Is it's an objective overlay on my charts via the 10 and 20 period moving average to keep me on the correct side of the market. So in what I call a green light environment, price is above the moving average, or maybe it's coiling below the moving averages and getting ready to break above. I really only take long trades. And then in a red light environment, where we're below the moving averages, or possibly getting ready to drop below the moving averages, I'll mostly be in cash, but you could take some short trades too. But it's basically just assigned to me, hey, this environment is not beneficial to making money, kind of go into protection mode. So that's key for me. And overall, this cycle of price action, when I get more into it, there's different stages to it. But it's a great way to allow you to kind of adjust your market exposure and how aggressive you want to be based on where we are at in the cycle. All righty, so I'm going to kind of start at the bottom of the cycle. So basically, when you have a market kind of, it's been in a downtrend, it's selling off, and at some point in time, not always, so not all of these steps always occur perfectly in unison. Sometimes you may get them. Well, let me just explain the reversal extension, work through it, and then I'll kind of talk through some other things. But basically, the reversal extension is once we've kind of been in a downtrend, we may start to get extended, a little overheated to the downside from the 10 period exponential moving average. Oftentimes you'll see heavy volume capitulation, and it's generally a sign that a market may be potentially bottoming. You don't necessarily know that till after the fact, but that kind of fear in the tape is the first sign of a bottom, and you'll often snap back, usually to the 20 period moving average, and then you'll start to see volatility contract, and you'll kind of have step two of the cycle for me, which is what I call the wedge pop. So for me personally, this is kind of the step where I really like to get involved in the market. I find even if you kind of catch the low via the extension, there's so much volatility in this, period here that you can often get knocked out. So the key is you kind of come up to the moving averages and you base out, you see volatility contract. And then when you pop back up through them, for me, that's the real first beneficial time to get involved in the market. So I call that the wedge pop. And then when you get that first pullback to the moving averages, I call that the EMA crossback. This is another low risk area to try to execute and get long against the moving averages and try to hop on a potential trend. And then from there, you have what I call basin breaks. So these are essentially, pullbacks to the moving averages. They're usually more than like a 1, 2, 3 day pullback, like a 1 to 2, 3 week base or something like that. And you could, in theory, have as many of them as the stock will continue to put in, but oftentimes you'll get 1 or 2, and then you're kind of getting a little bit late in the intermediate term trend, and you'll have what I call an exhaustion extension, which is essentially the opposite of a reversal extension. But rather than fear kind of taking over the tape, you start to see euphoria. You'll start to see people start to chase the market up. People start to get really excited about how much money they're making, etc. And when you get extended to the upside, that's often a time to sell into strength. You don't always know that this is going to be the top. The confirmation of that is the ensuing wedge drop. So let me step back over here to the left side. So you've got your exhaustion extension. You'll pull back to the moving average. Then you'll generally kind of base, maybe the market will try to work back up, but it just doesn't quite have the power. And then when it drops back down through the moving averages, that is a sign that, hey, we're in that red light environment now. I want to be more conservative. I want to protect my capital. And oftentimes you'll go through these exact same steps to the downside, but they'll happen much more quickly than on the upside. What might take 6, 8, 12 weeks, and I'm talking on the daily time frame, to the upside, that could be like 2 to 4 weeks on the downside. So you get the wedge drop, the EMA cross back, you might get a basin break, usually only one, and then you'll get like a reversal extension. So that really is the whole price cycle. So a couple things here, is that this works on all time frames. So I literally, whether I'm trading on the 5-minute, the 15-minute, the hourly, daily, weekly, monthly, whatever it is, I am using the exact same strategy. So that's important to highlight, just because I find that it allows you to be lethal, and that you're never kind of having guesswork in what you're doing. So that's the overall price cycle. So I am more of a swing trader. My main time frame is the daily time frame. So I like to apply multiple time frames. I'm sure Brian touched on this quite a bit in his presentation yesterday. But the way that I kind of set up my trading business is, the higher time frame for me would be the weekly or monthly chart. I want to see the complete picture. How extended is the stock, or has it been in a multi-month base and we're potentially just starting a move? Where are we in relation to the 10-week moving average is key for me. Ideally, I want to be getting involved in bases that are just kind of getting going, out of a 10-week or out of a weekly base, and the 10-week moving average can be a great way to judge that. And then I always want to ask myself, am I fighting a higher time frame trend? You may think, hey, I've got a 2 to 3 week base in a stock, but it's right after, a monthly, shooting star that's extended from the 10-week or 10-month moving average. It's unlikely to work. So from a higher time frame perspective, those are some of the questions I'm asking myself, so that when I do step down to the daily chart, to my actual trading and execution time frame, I'm in alignment with that higher time frame. So then when I come to the daily chart, basically this is where I'm analyzing, the daily bars and those daily 10 and 20 period moving averages, to actually set up my trades and execute, to set up my trades. And then from an execution or, risk management perspective, I'm looking at the hourly or 15-minute chart. So the reason I drill down into the hourly or the 15-minute is because I can get a trade on, based on that time frame with tighter risk, which can allow me to increase my position size. So that's why I do that. So for the most part, on the weekends, I'm going through my higher time frames and I'm kind of scanning the entire market. And then when I kind of come up with my overall list for the week, I'm going to my trading time frame, the daily time frame, and I'm, mentally setting up my trades. Hey, this is my pivot. When we clear this level, I want to get long, etc. And then throughout the day, let's say the, 5 to 6 stocks I'm really interested for the day, I'll have the hourly charts of each of those names on one of my screens. And then on my other screen, I'll have like the weekly, daily, hourly, 15-minute, so that when I actually see something starting to happen, I can pull it up there and I can drill in a little closer with the 15-minute. Then lastly is what I call the laser focus time frame, or really I kind of just made that up for this presentation, but the 5-minute chart, I really use this mainly in two ways. So, if I am doing some day trading, I'll be looking at the 5 minute, but for the most part, I use it when I get an intraday reversal extension off of a daily support level. So let's say I'm trying to buy a pullback to the 20 period moving average on the daily chart. I might be looking for a reversal extension on the 5 minute chart. That's about the only time I actually trade the reversal extension. I find it's a harder, pattern to execute. So maybe if you're starting out, you kind of wait and you play more of those intraday wedge pops because they're kind of easier to spot. And then I utilize it on the open. So if I have a lot of conviction in a trade, maybe it's a chart with a big base, and it's got an earnings catalyst and it's gapping up, and I want to trade it right on the open, I'll be looking at that lower time frame chart. One thing I would say, just in general, is don't get in the habit of looking at the 5 minute chart unless you're at a higher time frame level. Because if you're looking at the 5 minute chart all day long, you're going to see a ton of trades that just aren't there. You can find patterns every 5 minutes on the 5 minute chart. And the key is to make sure you're looking at that time frame at an important higher time frame level. So that's key for me is combining these multiple time frames to make sure that I'm putting on the highest probability trades, where I've got, the weekly players, the daily players, the, hourly or intraday traders are all trying to buy my stocks at the same time. It's going to give me a better chance of having success. So kind of is what I view as the advantages to my system, is you're either above or below the moving averages. I mean, it's extremely objective. You can't really lie to yourself. You're either above them or below them. It's that simple. And then two, kind of what I've talked about is it's fractal in nature. So I don't even really need to know the time frame. If I'm looking at the chart and I'm sizing up the moving averages, I can execute. Naturally, if you're trading on like a 15-minute or an hourly time frame, you're going to have more trades, you're going to have more whipsaws. Whereas if you're working off a daily or something like that, you're going to have wider stops, less trades. But in any scenario, I'm executing the exact same way. And then really price is the number one indicator for me. So a lot of people on Twitter will ask me, hey, do you buy like through the moving averages or down through the moving averages? And one thing to highlight is that you're really actually trading off the price bars and the actual price action, and the moving averages are more there as a guide to you. So that's very, very key, is to make sure that you're focusing on the actual price action and using the moving averages to just kind of help you determine what's happening. Then with my approach, you're always buying strength. So let's say I'm buying a pullback and somebody might view the daily as declining or weak at the moment in time. That's fine. I'm going to be buying strength on the lower time frame. So maybe it's pulling back on the daily chart and I'm looking in at a lower time frame, say the 15-minute. I'm waiting for it to show strength on that 15-minute time period, mainly because that's just what fits my personality. I like to buy breakouts. And, if I'm going to be trading something that's pulling back, I'm still looking for it to show strength. So the trend will generally turn on the lowest time frame. The trend will turn on the 15-minute, and then it'll work up, to generally find resistance at those hourly moving averages, kind of base out. Then it'll push the hourly moving averages. That's kind of confirmation to you, hey, we're turning this trend. And then, lastly, it'll get in unison with what you're seeing on the daily chart. And then, so yeah, utilizing the faster moving averages should also keep you in the best stocks. So a lot of people like to use the 50-period simple moving average, and I keep it on my charts. I'm always aware of where it is because I know a lot of people are looking at it. But as what I've found is, I'm usually holding 8 to 10 stocks, if I'm fully invested. And if I'm in, top 10 stocks, I feel like they should be trending above the 20-period moving average. And if they aren't, then I think I can get something better. That's just my personality. I haven't back tested, or that's my opinion. I haven't back tested that or anything, but it's pretty much been proven to myself that is the case. And then my personality really is, I don't have the personality to hold through bases, to hold, through a stock that's going to come back and test its 50-day. I'd rather just get out when it loses the 20-day and get back in, down the line when I see it set up again. So another thing is you can easily spot relative strength by buying stocks that are quote unquote ahead of the indexes in their cycle. So if you see the index or the NASDAQ or something is having a wedge pop and you're buying a stock breaking out of the base at new highs, you're literally confirming that thing's showing relative strength because it's ahead in the cycle. So it's a very easy way to judge that. There's many other methods to do that, but that's a very, very simple one. And then lastly, there's no excuse to ever chase. So if you miss a wedge pop on a stock, okay, no problem. We know what's coming next. Let's wait for that pullback to the moving average and try to get in at the next low risk opportunity. So to me, those are some of the key advantages to what I do. Some disadvantages. So using, a 10 or 20 period moving average versus a longer period moving average, there's potential for more whipsaws. I would say trend following in nature, which is really what my strategy is, can have more false signals in range bound environments. I think one of the advantages to what I do though is you can lower your time frame in that range bound environment. Maybe you start executing more off the hourly or something like that, and you can continue to be a trend follower, but you're adjusting your time frame. So that's something to consider. Then it still is discretionary. I actually view this as a major advantage. I think kind of the safe thing to say is that, discretionary trading is risky. But I think it's a major advantage kind of once you really learn the strategy and fully commit to it. Naturally, it does open the door to some emotional mistakes and things like that. I certainly make them. But I think over time, I've gained much more confidence in my strategy and my approach. And I think anybody trying to build their own trading strategy, the key is to try to make it as rule-based as possible, and just fully believe in it so you stick with it. And then lastly here is, the strategy in and of itself is not complete. So I don't think anybody's strategy should really fully ever be complete. I mean, using different techniques are going to allow you to have more success. I mean, if you're buying high relative strength stocks to the long side, they're going to do better than low relative strength stocks. If you can find unique situations, I'll talk about some gaps when we look through some charts, things like the wick play, support and resistance, different candle patterns. If you can find huge volume signatures and then look for opportunities to kind of get on that trend. And then lastly, just proper stock selection. If you're trading companies with big earnings, big sales, all the things that are in how to make money in stocks, generally speaking, maybe not so much as this year, but generally speaking, I think over time, you're going to have more success than if you're buying companies that are declining. So, any other things you can do to, kind of put things in your favor are going to help, the cycle of price action or whatever, have more success. And then lastly, I don't think there's any replacement for the well-trained eye. So I think everybody will tell you when you start to trade, commit to a strategy, don't hop around. And I think that's definitely true. You do kind of have to kind of get into the game, make mistakes, to fully learn something and to have faith in it. So I don't think there's any replacement for the well-trained eye. All right. So what I'm going to do now is, I'm going to kind of look at some of the recent stocks I've been trading, just kind of talk about what I was seeing, just because I think it's easier to, kind of look through things and talk through it rather than just a model on the screen. So I'm going to look at, Crowd, Net, Asan, Roblox, NVIDIA, Snap, and SE. And then after that, I'm going to talk about some stocks that I was trading a lot last year. Then I'm going to point out, some of the signals that could have helped you, avoid these pullbacks that we saw in these names. And then with Peloton specifically, I'll show why I think it could potentially get moving again. So let's do that. Alrighty. All righty. So is what I'm going to start with. I'm going to start with crowd, and I'm going to be focused more on the daily time frame, just because that's kind of how the presentation's set up. But take into account that I am looking at the weekly, and I'll try to show that. But I've written a lot of stuff on here that kind of makes the weekly look crowded. But basically, is what I'll do is I'll briefly start here, and then I'll focus more on this kind of more near-term trade. But it's what we saw here is if you kind of zoom out to the weekly real quick, and I apologize, this is going to be a little messy, but you can kind of see that we had this big run last year, and we've been consolidating. So we kind of lost the 10-week moving average. We've been basing. We kind of put in the bottom of this base around this 170-ish area, and right in here is where we kind of defined this 227 area, which we've recently taken out. But a couple things to highlight here. So as we're coming up here, you see this kind of stall candle when we try to push out of this bull flag, just kind of like a sign, hey, we're seeing a little bit of distribution, nothing crazy in that we actually put it in an EMA cross back here. We hold the 20 EMA, but then you can just kind of see that, another sell down candle, this kind of has an outside reversal here at new highs. And then we have what I call a wedge drop here. So you can kind of see this little mini pivot defined. And when we lose it, it's just a sign this stock doesn't quite have the momentum to really push higher without some more basing. So then here on the downside, so like I said, on the downside, things happen much more quickly. We kind of trade up and come back down. You could do that as the EMA cross back. And then, we base and break here. And then down here, we don't necessarily really have a true reversal extension. I guess you could say we get pretty extended from the 10-week and we trade back up. But you can see here, it's just not ready. We roll back over and we need more time to base out. But as what you do see here is the same way kind of the price action tightened up here and folded back to the downside. We're in a process down here at the bottom where we've got 1, 2, 3, 4, 5, 6, 7, 8 days of pretty tight price action. And you've got some nice clues in here that momentum to the downside may be stalling out as well. So first is you've got this kind of heavy volume, kind of capitulation. Then right here, we take out this pivot low. And we trade back up with a bullish engulfing on big volume. To me, that's not a sign to get long the market. It's just a sign that, hey, we took out this pivot low. Sellers couldn't follow through to the downside. So maybe buyers are going to start to get more aggressive here. And then we start to tighten up. We more or less have an inside bar here, an inside bar here, inside. So I'd love to see inside bars. Because really it's just a sign that volatility is contracting. In retrospect here, you may have even tried this long here and it would have scummed and failed. But in reality, the true buy area for me is when you set this pivot right here between this day's high and this day's high. It's kind of lined up right with the moving averages. And then I also had this little kind of mini declining trend line drawn right in here, where we've got 1, 2, kind of 3 highs. So I always want to have 3 pivot highs to connect. And then this is a wedge pop right here. So you could we'll call it 193, 194 area is the buy area. That's the wedge pop. And then another thing I would highlight here is that with a lot of growth names kind of making a lower low here, crowd actually made a higher low. And if you look at this weekly candle, this is a doji candle. And when we kind of get above that same level on the weekly bar, that's actually where our wedge pop is triggering. So we're pulling back into this weekly trend line. We're putting in a higher low. So even though this isn't necessarily one of the strongest names in the market at the time, for the types of kind of secular growth leaders I trade, it was actually outperforming a lot of the other names out there. So basically we signal this wedge pop and we continue to work up. So right here, we take out this next pivot, keep going. So for me, I like to get my stops kind of in the money, you know, in an intelligent manner. We have all these moving averages below this daily low. And when we follow through, it's a good area to kind of raise your stops to make sure you're kind of, protecting your principal capital. And then we trend higher. So right here is kind of the first step that we're seeing some potential profit taking. I actually thought that this was going to prove to be an EMA crossback, this pullback here, and we were potentially going to set up a base here and run higher. But we came into this 227 level again. And I think kind of one of the themes this year we saw with the April run is that selling into resistance and some of these basing patterns has been a profitable move. But I knew we had earnings coming. And basically when we took out this low, I just didn't have a huge cushion. I had like a 20 or something point cushion. And I decided to just kind of step aside and let earnings get out of the way. And we did shake out these moving averages. So that's kind of one of the flaws this year with my approach is you're having much more whipsaws. So you kind of have to make an adjustment there. But I am hoping that we're coming into a better environment and that we had earnings, we kind of shook out there, but then we did hold the 50-day. So that is one of the reasons I keep the 50-day on my charts is, you just kind of want to know where it is. So I kind of viewed this almost as like the EMA crossback kind of, and then I viewed it as what I call a trend knockout. So if you follow me long enough, you'll see that I really like to look for opportunities where a market maybe, takes out a level. In this case, it would be these shorter term moving averages, but then it recovers, showing that it shook out the weaker hands, the guys like myself who are maybe a little bit faster, but then it recovered. And what we did here is we kind of put in what, sort of like a 2-day, it almost looks like a flag. I call things like flag-ish patterns. The key here is that this day took out this day's low and sellers couldn't take control. We held this 20-period moving average. And then when we flipped this high, I pretty much, got back long this stock again. I felt like at this point in time, this weekly base had really taken shape. And now at this point, we're breaking out of the weekly and we'll see what happens. I need to see a pullback here to kind of see if we're going to respect these moving averages or not. I'm not sure. But that's kind of how I've traded crowd here, kind of how the price cycle, basically you're able to avoid this down move. You're able to get long back here. You did have a little bit of a whipsaw here. And I do think that this was a tough catch and that it went quickly. But if you had kind of paid attention to that big weekly base and overall what this thing had been doing on a higher time frame, I think most people should have caught this. So we'll see what happens with crowd here. I do think it's kind of just breaking out and it's been one of the growth leaders of the market. But that's kind of how I've been trading crowd. And, Richard, I don't know if there's any questions on that before I look at some of the other ones.
Yeah, there's plenty of questions coming in. One that somebody had was, where are you placing your stops here on your entries when you get in?
Sure. So I am sort of a momentum trader in that oftentimes if I'm not in the money at the end of the day, I'll actually just sell the stock and buy it back the next day. But I always have a safety stop, no matter what. And that is, partially how I determine my position size. So in this instance, kind of when we take this level out, what I call my max pain stop, if you will, is right around here or around 187. So call that, like a 6-point stop, about 3%. And then if you're drilling in on a lower time frame, I don't have the lower time frame in front of me at this point. But I would be looking at that lower time frame to potentially try to tighten that up even more. But usually when I'm buying a breakout, my max pain stop is always the daily low. So this did have a little gap down shake the next day, which, it's going to allow you to stay in it as long as it maintains that daily low. A lot of the time on the open, I like in these situations to kind of let things settle down for, 20 to 30 minutes. And then if things come back up, you'll actually, for me at least, I'll adjust my stop up to that new low. And then with this trade here, when we take out this pivot, I call this, reconfirming price strength confirmation. So if we trade up and we create a pivot and we take it out, I'll move my stop up. And then really all through here, I'm kind of waiting for that next opportunity to raise my stop, which unfortunately we just never really got in this instance. The stock kind of, crapped out, if you will. But right here, so just full transparency, I did actually buy some of this here. I just, I saw the action and I did. But really this trade started for me in here when we took out this daily high. And in that instance, my stop is right here. So call it, I think you could have caught this. We'll 217, but let's just call it like 218 because it went quick. And if the daily low right here is 214.76, you've got about a $3.25 stop on a, $230 name. So what is that? About 1.5–2%. That's a pretty good deal on one of these $200 to $300 names that, this name can definitely move when it gets going. So I think that's pretty good risk reward. And if you think about this, we've already moved 15 points. So for me at this point, there's just no way I would possibly take a loss on this trade. I haven't really moved up my stop yet because I'm kind of seeing, let's say we pulled back on Monday. I'm not saying that happens, but had a new pivot and then took it out, then I would move my stop up to here. So at this point in time for me, we'll say my stop, call it that it's like right here at like 218. And I'm sort of in wait and see mode. Like what's this stuff gonna do? And then I'll adjust my stop kind of, once I see what it wants to do next.
And could you give us a sense of your kind of your target risk reward, as well as kind of your batting average, average gain, average loss, holding periods, all that?
Sure. So my target risk reward, I mean, in reality, I'm looking for setups and I'm looking to keep my risk really, really tight. And I wouldn't necessarily say I have an upside reward, if you will. I'll try to ride this as long as it wants to go. So, if you look at this scenario, this trade didn't really work. We had like a $6 stop, but, quickly I get my stop in the money, and then unfortunately it doesn't work. And I think I probably made about 3-1 on this. But ideally I'm looking for situations where I can really kind of catch a trend and I can make a massive multiple on my risk. That's really where I'm going to make money. And then as far as from a batting average, I would say my trades that actually legitimately turn into, what I consider real winners, it's probably only like 15 to 20%. And then I would say these types of trades are probably about 20%. And then I do take a ton of scratch trades. That's probably the majority of my trades are actually, scratch trades where maybe I think things are going to move off the intraday chart. They don't quite move. And rather than kind of go red, I just check out. So I know that's probably not the best answer to your question, but that's, that's pretty much how much.
No, that's perfect. That's perfect. And we've got a question here about executing your trades. Are you watching the tape and pull market orders? Are you setting stop buy orders? And do you use alerts to keep track of stocks?
So yeah, so like when I come into the week, I'll have kind of my focus list, and then every day I've got my what I call my daily list, which is really the 3 to 5 names I'm focused on. But over the weekend, when I go through charts, I'm setting alerts all over the place. Like I probably have thousands of alerts set. I don't even know. And they'll go off at random times. And that doesn't mean I'm going to take those trades because I don't too much like to just take random trades. But I've got alerts set, and maybe an alert I set 2 months ago triggers, and then I'm like, okay, I got to pay attention to this thing again. So I do set alerts. As far as like the names on my daily list, I mean, I'll have alerts set on them, but I really shouldn't need them. I mean, I have on my daily list, I have all those stocks up. The hourly's up on my right screen, when I'm at my main trading station, and I'm watching those. Like, that's what I'm watching all day long. I'm really focused on the key names that I pick out from the night before, because I just don't want to miss those opportunities, because I really did the research and the work, the night before over the weekend.
Right. And we've got some questions on reversal extensions. And I guess part one of the question is, what kind of percentage above or below is that reversal extension, or above the moving average or below the moving average if it's on the opposite end? And somebody asked, why isn't 511 a reversal extension with crowd? To that big green bar, the bullish engulfing.
So, I mean, you could view it as a reversal extension. I sort of think this is more the reversal extension right here. I would say, don't get caught up so much in the exact specifics. Just kind of understand, this is potentially a bottoming in this price cycle. And now let's wait and see more information. Okay, we see a tightening in price action. And then, for me, I'm not trading the reversal extension. So like, I'm not trying to buy this because, it goes up, but then it comes back, and then, they scum the stops here. Even if you catch this, it goes up, and it really, unless you really, really got a great price down here, I mean, it retested your price. So I'm generally trying to wait for this contraction and then play the wedge pop, but kind of spotting the potential for a reversal extension, allows me to, just kind of be more, just to be kind of looking for that next setup in the cycle. So I don't think it's so important here to know, hey, it's this day or it's this day. It's more just kind of understanding we may be putting in a bottom here.
Right. It's constructive price action for sure. And there's a question earlier, how much percent from the 10-week moving average would you consider the stock to be extended?
So it's different for every stock. I mean, every stock has its own personality. I I almost kind of visualize it. So like, for example, if you look at last year's run in the stock, I mean, we pretty much stair-step higher all through here, right? I mean, I know we had a little shake out of it here. But up in here, you can see we've got a lot of air. Right here, 200. I mean, we're about, 12, 13% above the 10-week, or actually at the top of this bar, we're even higher. So I more eyeball it than a specific percentage, just because each stock kind of has its own personality. But I think you start to get, more than, call it, you start to get like 12 to 15% above the 10-week. A stock can definitely continue higher. I mean, I've seen stocks get like significantly higher than that above the 10-week. But that is a scenario where you want to start looking at, okay, how long has this stock been trending? How many bases have we had? And you want to start to be a little bit more aware, potentially maybe take a little bit off the table, because you're likely getting more extended in the trend. So I don't have a specific percentage. I kind of look at it all in context of the overall trend in the stock.
Makes sense. And this is a good question from Todd. Can you expand on the confirmation of turning the trend on the 15-minute chart? What convinces you that the trend is turning up as opposed to just bouncing on the shorter time frames?
Sure. So let's let me drill into a 15-minute on. Let's see. I know Peloton had I mean, this isn't the best example because it went right on the open. But basically, we'll try to use this. So if you look at this, I was kind of looking at this stock. So one, let's just look at Peloton, because I think this is a good example of one, kind of how to avoid these pullbacks in the market, and then two, kind of what happened next. So if you look at this stock last year, we had this big IPO base. We'll call this the stage one base right here. This is kind of stage two. Stage three gets a little bit looser. So anyone who follows O'Neill, you start to see this looser price action, but we still do handle these weekly moving averages. But then we get more extended. So if if you guys read my book, I talk about the second extension. So I'm mostly using that on the daily chart, but it's relevant on every time frame. So you can see this is the first extension on the weekly. This is the second extension. It's also a 4-stage base. This is kind of a red flag candle in that we make a new high and fail. And then if we drill into the daily, chances are that because of where we are in the weekly, this is going to fail. So kind of what happens, we have a wedge drop right here. It kind of doesn't really follow through down. But to me, you're seeing a lot of flaws in this basing structure, in that we try to go here and we then proceed to gap down. So I hate gap downs. I like gap ups. I hate gap downs. Then we get a bearish engulfing here. And then in reality, this is kind of where this downtrend starts in Peloton. And hey, I need to step aside here. And we proceed to go down. This is the crossback. This is the base and break. This is the extension. The first time you could have potentially really got long, this is in this area on this wedge pop. But then pretty quickly, it peters back out and you have a wedge drop failure here, gap down, and we kind of continue this cycle until we get this big bear trap right here. And you can see this just massive volume on the shakedown here, which to me, the way I trade at the time, I'm still thinking, this thing could go much lower. I'm not thinking this could go higher. But once we kind of get back above this level, I realized, some people were trapped. We set a wedge pop, a cross back, which unfortunately, personally, I sold right here. But I realized that this stock is setting back up. We've got a big weekly wedge, and we had this kind of flag into the EMAs, this flag into the EMAs. And so if you were to kind of look at these kind of lower time frames on Peloton here, specifically, in this flag, we had the hourly EMAs and we wedge popped through. It just wasn't quite ready, but we did this same thing on Friday. So you're really looking at these moving averages just like you would on the daily time frame. And so right here, it's ready on the hourly and it fails. If you're like a day trader or someone, you made 4, 5, 6 points there. That's great. But now I do believe that not only did this trigger on the hourly and that we pushed through the moving averages, but I also think that you're seeing the weekly setup and you're seeing the daily setup. And I think that we're getting ready to see some potential continued upside follow through here. So, on the lower time frame, things trigger the same way. It's just, remember, the trades are going to be shorter term because you're trading off that lower time frame. And to get that sustained move, we've got to have a continuation of that trend on the higher time frame. I don't know if that answered the question, but I'm trading the same way on the 15-minute, on the hourly, or the daily. And sometimes that means you get a 15-minute long trigger, and then, you get a 15-minute wedge pop, like right here, there's like a 15-minute wedge pop, I'm sure. But the higher time frame still sound. The lower time frame, it just needs to turn again, and it needs more time to turn that daily chart or that weekly chart time frame, if that makes sense.
Yeah, perfect. That answered the question perfectly. Another question that we had was about position sizing. So among your holdings, how are you allocating capital? And how do you manage your overall portfolio as well?
Sure. So my kind of, my quote unquote top ideas, I'm generally putting like 25 to 35% of my account in those trades. Now I'm not going out and clipping off a 30% position. If I think something could be a top idea for me. So, in this market, the top ideas for me have been Crowd, Net, NVIDIA, and Asan, just because, and actually Snap would be there, but for whatever reason, I'm not as big there. But the reason being is those weeklies have shown the relative strength to other things. Like I really, really like this Peloton. I love it. I think it's going higher. But because it's kind of further off the highs as Crowd, it's not going to be a top idea for me. This is like a 15 to 20% type position. Now, if it went up and it really started to outperform and kind of, do what I call earn more capital, maybe I would increase it. But the way that I'm determining a top idea is, one, it's got to have like a game-changing story. So, like Roblox is a great example. I think kids are going wild for Roblox. I honestly don't know anything about it, but my two nieces play it. I see kids all over the place playing it. My sister's children are all over it. So it's kind of like a new product. So the N in Can Slim. And but more importantly, it's got to have like a sound weekly chart for me. So I'm never going to make a top idea something that's, extended, and maybe it's got like a short daily chart consolidation. It's got to have the weekly, it's got to have the story, and it's got to be, outperforming its peers from a strength perspective. So I'm usually holding 2 to 3 in this market right now. I've got kind of 4 top ideas, but they're more in the 25 to 30% range versus the 30 to 35. And then I'll have kind of what I call core positions, which are generally, positions like, maybe 4 through 7 for me, which are kind of more in that 15 to 20% range. I don't hold that many names, so everything that I'm holding, I love, I want to own. But for whatever reason, it just doesn't quite, break into that top 4 or top 3. So I'm just smaller in it. And then, sometimes, like, I know a lot of people have been trading UPST lately. UPST has been a very, very high conviction name. It's been a great story. I'm not so sure that its best days, at least in the intermediate term, aren't behind it. But that name, I mean, it's going to be tougher to hold a 30% position in UPST versus crowd just because of the volatility. So you do want to take volatility into account as well. If you have to give something a huge stop, you've got to take a smaller position because you're taking more risk. So I take that into account too.
Perfect. And maybe you could talk through Tesla as well, because I know you were probably trading around a larger position last year and holding it for kind of the longer term move. So you talk about ultimately selling a position and what makes you sell out of all the stock.
Yeah. So, I mean, Tesla, I won't go through all this. I think if you did that, if you guys want to hear me really talk about this, watch that first video I did with Richard. But I do think Tesla is important to look at because Tesla clearly led the market last year, right? And it's been out of favor this year. And, kind of why have I, I've still traded Tesla, but I've been less aggressive with it. And part of the reason is, if you just kind of look at the basing structure in Tesla. So to me, this is like the first stage base, first stage cup and handle. We go up. This is kind of like the second stage base. And then we start to get very extended. So you can see the air to the 10-week. I mean, we're pretty extended here, in that we're about 140 points ahead of it. And then we even accelerate more. So if you saw the video I did with Richard, I kind of talked about how, I'd been in Tesla, but I'd gotten out of it up here, and that it maybe needed some time to base and it might go higher. I just wasn't sure. But in reality, we were just extended from the 10-week. And this candle right here, we kind of took out this weekly bar high and failed. And that's kind of a red flag. We saw that in PTON. And then really when we took out this level, you kind of knew, hey, this trade's over. And if you look at that on the daily time period, you can see it more defined in that we had a failure higher. This would be the wedge drop. So we drop below the moving averages. This to me is, like a crossback or a basin break, and when we go lower. And one thing I'll highlight on Tesla is that we actually had a second extension to the downside, which to me is a sign of some real weakness. So this to me is a reversal extension, but we come up, and I wrote red light here because we rejected the moving averages, and then we actually kind of base and take out the lows again. So you do have to take that in context of the market. But in reality, because we're below the moving averages all through here, there's no reason to really be paying attention to this stock. Now, I did take a trade in Tesla. I got it on this day. And we basically come up to the 20 EMA, and we start to see that volatility contract. You could view this as an inverted head and shoulders. And when we break back up, I actually added on this crossback. I gotta say, I thought Tesla was going to rock it here, and I proved to be incorrect. And we got another wedge drop here. And to me, I have, Tesla's one of those stocks I do kind of short-term trade a little. I do think Tesla is actually getting ready to go higher again. But I think after last year's move, my hunch on this thing is that it's going to go higher, but it's, not going to quite have the firepower that it had. It may need a much, longer basing period. Sorry, there's so much stuff on here. I mean, if you look at the monthly, it's actually coming together. But I just think, after the move it had last year, it may need some more time. So that's kind of how I'm approaching Tesla here. I just think that there's better opportunities in that, something like net is breaking out to new highs, whereas Tesla's kind of on the lows. I want to be in the nets. I want to be in the NVIDIAs that are breaking out. I want to be in the crowds, the Assans, So it's not so much that I don't think Tesla's going to go higher here. I actually sort of do. I'm just not sure it's the best bang for my buck. And I don't need to own everything.
Makes sense. And maybe you could go through SE quickly, because Marshall has a question. He's curious to see SE example, late stage and wide ranges. What makes this get to the top of your list, and how have you approached this one?
Sure. So I often hear people say things like, oh, that's a 9-stage base, or, for example, and I don't want to go to anything else here, but I hear people all the time say, I can't believe you're interested in SHOP, blah, blah, blah. But I sort of view these are disruptive, great companies that in reality are not. I look at the market cap a lot, and I think they've got more room to run. Like, I actually think SHOP's going to get going here again. But I kind of view SC as the same thing. And if you consider the fact that, we just looked at Tesla, right? And let's go look at where Tesla made, Tesla was the leader of the market last year. And we come down and we make a second lower low here in 3.5. And really on 5.19, we basically test the lows, right? So let's look at 3.5 and 5.19 on SC. So did I say 3.5? So in reality, SC tried to hold up when Tesla had been correct in a while. So this was kind of trying to hang around, and eventually it succumbed to market weakness, right? But then we made a higher low in here. I mean, I guess this isn't the best example, but we're already like back up near the highs. Whereas if you look at a lot of these other growth names, Roku's off the highs, Pins is way off the highs. Some of these may never come back, but SE is already at its highs.
Right.
I had sort of determined in this range that it was one of the top performing growth names, kind of with Snap, Crowd, and Net. And I thought the earnings here were excellent. So we kind of had a gap down here. I call this a bullish counterattack bar, where we gap down. We actually gap down right into the support level, and we exploded with volume. So to me, this is a sign, and I didn't trade this day, but I watched it. And I viewed this as a sign that sellers were kind of sold out on the stock. And then they gapped it down again the next day and bought it up. And to me, that's a sign, institutions need to own more of this thing when they do things like that. When the big players gap things down and then buy it up, they're trying to get more shares on. So I actually got in SC here on the open. And one of the things I like is that we had a gap up here, and it remained unfilled. So I love unfilled gaps. I think it's a pure sign of strength. And then we had an EMA crossback here, and I actually, unfortunately, I got out of this right here. I just felt kind of like Crowd. It had lost momentum. Crowd was testing the highs, SC wasn't. So in the short term, I kind of viewed it as relative weakness to the true growth leader in Crowd. But then it's set up back in here. It's reconsolidated into the moving averages. And look, I could be wrong. SC may crap out, and it may not work. So I guess as far as it being, late stage, I don't know. We'll see what happens. I'm long the stock. I think it's gonna push out, but I could be wrong. So I guess I don't best know how to answer that question. That's just kind of how I interpreted the action, and we'll see what happens.
No, that's great.
No.
And could you go over ASAN as well? Because that's an interesting one. It's got a nice earnings gap up, and then some really strong breakout last week.
Yeah, so Asan is one that I'm, these other names I think are great, but I'm excited about Asan because it's kind of new merchandise. I've also gotten some good feedback from, what I call the quote unquote research team, my brothers, my wife, etc. on the product. People seem to really like the product. But if you look at the monthly here on Asan, I like to trade IPOs after the 6-month mark. I'll trade them before, but usually I'm kind of flipping them into strength pretty quickly. I treat them a little differently. But we basically put in 6 months, we put in this shooting star here, and we kind of pull back, right? So this is really the first true pullback. And the unique thing that happened here on the monthly here in Asan is when we took out this kind of 3780 area, because this to me is on the monthly chart, kind of the, buy area, right? We kind of come up, we pull into this 10, 20-month moving average. And when we take this area out, I feel like, okay, on the monthly, the wind is at our back, right? And then we come into the weekly, you can see it even a little bit more defined. So I've got the monthly, I've got the weekly. I like where we kind of held this support area on the weekly, and that this is, kind of the first defined level since the IPO, and then we hold that. And then on the daily, so we put in earnings and we had a big gap up. And so I actually bought this here, and I had to get out of it and then rebuy it. But if you look at the whole complete picture, we have a wedge pop off the lows. This was not on my radar here. We then had an EMA crossback, and then we gap up on big volume on earnings. So that's what I call a bull snort. That's like, hey, your ears should perk up. Hey, what's going on here? Oh, we've triggered the monthly spot. We've triggered the weekly spot. And now we've got this big gap up. And then to me is what we did here is we pulled back and we put in, sort of like a bull flag. And then, so I got in it again in this area and then in this area. Right here, this is technically a wick play, sort of, and that we gap above here and we hold it in on the wick area and then we head higher. So we have a second gap here, which I love, another sign of strength. So we've got 2 gaps. Big up day on volume. The CEO bought, a bunch more shares, which is always a great sign. You definitely want to see insiders buying. And then to me, we consolidate on light volume here. And I would love to see another sideways day Monday and then kind of reconfirm. But the way that I trade, I have absolutely no idea what's going to happen with the sun here. I have no idea whether it's going to go to 50 and crap out or whether we're going to see this thing at like 80, 90 bucks. I'm basically at this point got in here, we moved up, I moved my stop up, we gap up again here. Kind of the way that I approach this is like, in theory, my stop is right here at 42 and a quarter. So I call this an ignite bar, and that it's a big wide range bar with volume. But I really like the stock. I want to give it the benefit of the doubt. So I'm sort of keeping my stop down in this 10-day-ish area. When the 10-day kind of gets above here, I'll more aggressively kind of move my stop up there, but I don't really want it to lose this area. So that's kind of how I'm playing this right here is, my stops in this range. And as the moving averages work up, if we got some sort of, basing day here, and then we reconfirmed higher, then I would move my stop up to below that basing area. But right now, I think Asan broke out on the weekly, broke out on the monthly, and I'm hoping that I'm onto a trend, and we can kind of see what happens with this thing. That's my approach here.
Perfect. And we've got a question here about entering on gap ups. Is that something you do, gap up days, and how would you play that if you do it?
Sure. So there's certainly not a perfect answer for this. I was fortunate in that I was already in this thing. A mistake I made is I should have been adding to this on this gap up. But kind of the way that I take gap ups. So if I have a gap up on a stock and there's no real reason for it, let's just say a stock gaps up, I'm generally going to be sitting at that first 15 to 30 minutes, let the stock settle, and then get involved. But for something like this, where you have a catalyst, let's say you weren't in this thing yet. And let's just say you for whatever reason, your target was like, I want to get a 15% position on. I'm a big fan of, getting some on. So maybe you say, hey, I'm going to put 7.5% on, letting it trade. And, maybe you have to pay up a little more for the rest, but you don't just want to throw like a huge position on, because if it reverses, you're taking a loss on a bigger position. So I think the way that I try to play these is I'll depending on what my target allocation is, which is something, each and every person has to come up with based on their conviction for the name. But I like to put about half on, and then, maybe add another quarter, and then add another quarter. So I like to try to work into it versus just put the whole thing on. Now, there are situations where if you have like a huge base and you've got earnings and you just have major conviction in the name, maybe you get more aggressive with it. But, I try to play out in my head before it happens kind of how I'm going to handle it from a position sizing perspective.
Perfect. And we had a few more questions here. Let's see. Do you scale out or do you take profits all at once?
Yeah, I scale out. I think it's generally a mistake to take profits at once. So here, I'll show you a mistake that I made here on NVIDIA. So I really handled NVIDIA well. I got into it here, which was pretty good, I guess. And then we had these three big gaps, huge sign of strength when you get these big gaps in a row. And I actually added here. Now, the mistake I made is I exited my whole position here. And the reason that I did that was, one, it had kind of been paying to reduce resistance. I'd kind of reduced my crowd and other stuff. And I saw us at this rising resistance line, and I felt that we were a little extended from the 10-day. And I took my whole position, which is a mistake, because that's not usually what I would do. I think if I felt this way, the smarter move would have been to logically step back and say, this is the leading stock in the whole market, which I believe it is. Maybe take half off if you feel that way. That's generally the way that you're going to have more success, in my opinion, is scaling pieces into strength so you can kind of let the rest run. So I did actually have to buy my position back here on Thursday. But so that's a mistake I made. So, long-winded answer to your question is, I do think it's smart to scale into strength rather than sell your whole position. Now, when I get the second extension from the 10 EMA on the daily chart, and I also determine that we're extended from the 10-week moving average, I'll generally take my position off.
Perfect. And in terms of overall market health, are you interpreting it the same way through the moving average analysis? And also, are you looking at how the leaders are acting, all those different factors?
Everything you just said. So, like, if we kind of look at the market this year, so one thing I was thinking, I watched Leif's presentation yesterday, and Leif trades names that move much more quickly than me. And I was asking myself, let's say I wanted to trade high type flags or things like that. Is my price cycle still relevant? And I think it is, because maybe right here, we lose the 20 EMA and we're in kind of a red light environment on the NASDAQ. Maybe you just decide, hey, I'm going to step aside for a little bit. So if you kind of look at the indexes, we're kind of in a red light environment here, really all through here. And then when we tighten up and we take things back out here, now we're in a green light environment. So you can kind of get aggressive with whatever your strategy is. And then likewise here again, we're kind of back in a red light environment. And I do think kind of right in here, we entered a green light environment. My overall opinion here is, we could come up and stall it here in base. But I just kind of have this feeling that we've consolidated for enough time, and I think we're going to push out and make new highs, but it doesn't really matter what I think. We basically made a wedge pop right in here. This was kind of a scum. So this was the day I kind of lightened up on some stuff, which was a mistake. But it proved to be a shakeout. And in reality, this is kind of like the EMA crossback. And right now we're trending above the moving averages. And maybe we find resistance here, maybe we go higher. It really doesn't matter what I think. I'll just take it day by day based on what we see here. Right now we're in uptrend for my time frame, and that's kind of how I'm approaching the market currently. And I'll change my mind if this changes.
Perfect. And people always want you to talk about the wick play. Can you talk about what that is and how you use it in your system as well?
Sure. So let's see if I can find one on here. Here was a good one that I took. So in Path, this trade was a couple weeks ago, and I sort of treat IPOs a little differently in that prior to the 6-month mark, I kind of view them as flips. But right here, we had just a short little base in Path, and we're kind of under this horizontal level, and right in here there's a wick under the level, right? So what the wick play is the wick play is you have a day with a wick. So we trade up, and sellers took control of that specific market into the close the previous day, right? So sellers kind of closed the stock off the highs. So the psychology behind the wick play is you get a gap up the next day, and you could kind of pull in a little bit. In this instance, we just went, but you could pull in a little. But the idea is that the market stays positive, so it doesn't go negative. It stays inside the previous day's wick as a sign that, hey, buyers are stepping up, and if they can take out the top of the wick, then those sellers that sold the market down the previous day have been overpowered by the buyers. So from a psychology perspective, you have sellers who took control of the market, and then on a gap up, there's kind of a battleground here inside the wick. And when you take out the top of the wick, it's a sign, hey, buyers are in control of this market. I don't really trade the wick play in isolation. So if I just see, like for example, up here, we saw a wick. If we had opened up here and traded higher, that wouldn't have been a wick that I had an interest in trading. It would have been a good sign if I had a position on. But I want to trade the wick in context of, an overall pattern. So we had a base here. I liked this 74 to 77-ish area, in the fact that we had a wick play at that level made it even better for me. So basically think about it. You have a wick the previous day, you gap up into the wick, the market stays positive, and when it takes out the top of the wick, that's a sign that buyers overcame the sellers from the previous day. And it's just a sign of strength. So it's just a tool, but always use the wick play in context of the bigger pattern. Don't just, buy random wick plays.
Perfect. And I think that's like an overarching theme in your entire presentation. Take everything in context, look at all the different timeframes. I think that's an excellent message. I think we've just run out of time, but thank you, Oliver, for your presentation. If you want to learn more about Oliver's methods, he just wrote an excellent book called Victory in Stock Trading. Go to kelltrading.com. Check it out if you want to learn more about his strategies and tactics. But with that, we'll take a quick break. And then next up, we've got Jim Ropel. Really looking forward to that one. But we'll see you guys in just a few minutes.
All right, thanks, guys. And any questions? I'm on Twitter too. I try to answer people's questions when I can, but always happy to help out. And thank you guys again for putting this on. This is awesome.
You want to pull up the website quick?
Yeah, go ahead.
Sure.
Make him do that.
So yeah, I wrote this book. It basically has everything I do. Not everything, but everything I could think of. Kelltrading.com. and it's gonna be coming out on paperback in like 20 days or so. You know, everything takes longer than I think it does. But kelltrading.com, you can get the PDF, or else the hard copy will be out in, you know, 3 weeks or so. And it's got everything from the price cycle to wick plays to kind of how I put my portfolio together. And then on Twitter, shoot me questions. If there's any way I can help anybody, you know, happy to do so. You know, we all win together, right?
Perfect. All right, Oliver, thanks again for kicking things off on day 2. We really appreciate it. Fantastic presentation. And yeah, take care.
All right. Thank you guys. Appreciate it.